Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today is Friday, April 10th, TGIF. April has been historically one of the best months for the stock market. I was just going over some data provided by Bloomberg, and over the last 25 years, the MSCI World Index has posted positive returns 75% of the time in April. In other words, 75% of Aprils are positive. And over this entire 25-year period that this report goes back, the market has written on average 2%, which is actually the strongest of any month in the US. And this is particularly driven by US stocks, which has a 70% rating and weight in this index. And it's funny, when you look at it, when I started working on Wall Street, I remember reading a book called Reminiscences of a Stock Operator. It's written by Edwin Lefebvre on the life of Jesse Livermore, this great stock operator in the 20s. They call him the boy plunger. Terrific. Was worth $100 million in the 20s, shorted the market in 1929. Just a great speculator. Talks about trading. It's an autobiography, really. It's a biography written as an autobiography. Anyway, and he talked about why bank panics happened in October. And he always said, basically, before the Federal Reserve Act of 1913, basically, the financial system was a lot less flexible. In the 1800s, basically, all through then, farmers needed to withdraw massive amounts of capital during harvest time, which you're thinking late summer, autumn. So they're withdrawing this capital. That would leave, like a lot of New York banks, really exposed for cash crunches. So if there was any pressure that October, while these New York banks had light cash, you'd see these market crashes. And that is what started our fear of October. And it's interesting how these kinds of things bake into the psychology, the seasonality. It's interesting that April, just on another psychological note, April is like the beginning of spring, it's one of those months. And where you have October, November is really like the start of the fall, and then September, October, the winter months. And they have Bloomberg's chart here has a list of the best performing months of the year historically. Number one is April. Number two is November, like right at about 1.9%. And number three, I bet you'd surprise a lot of people here, is July with about 1.7% positive. So April, July, and November, and the other positive months, October, 1%, and December, 1%, which would surprise a lot of people. But this is the last 25 years. This is after the 1987 crash. This is just basically since the year 2000. Basically what we call modern capital markets as we understand them, with the trading, with the flows, the world trade system that we have as we understand it today. So we see a situation here where April is a pretty good month. And this also challenges that idea, that old theory of sell in May and go away. You could see why they say that, because May comes in at about 0.2% positive return. June comes in at negative 1%. We said July already is 1.5% positive. And August and September are both negative. So you have basically of 5 months, May, June, July, August, September, only July is positive. So this is historically, we are in a historically good month for stocks. Now, why have stocks performed so well in April? It's a great question. A lot of folks postulate different reasons. Some of them say end of tax-related selling pressure. Okay, people for the first 3 months of the year, they've been selling stocks to get ahead of their tax bill. We all have to do that. Pension contributions hit in the first quarter for many people. So then they have more money to actually go and deploy that, which leads to institutional repositioning. So the point that I'm trying to make is here that seasonality favors the bulls, whether there's some psychological underpinning to this, the fact that it's spring coming, that people start to feel a little warmer, a little more optimistic. They look at the world as half full instead of half empty. Whereas when fall comes, September, then all of a sudden you start to see the glass is really, instead of half full, it's half empty. The psychology of that changes. And it's astonishing. Remember, we're humans. You don't graduate above being human. That's the bottom line. None of us do. So we are still very human in how we perceive things. And this really speaks, maybe, in a way to how we perceive things from even early man to now. Anyway, I always love these kinds of statistics. I love sharing them. I always find them a little fascinating, and I hope you do too. Have a wonderful weekend, and I will see you on Monday.